Good afternoon, everyone, and welcome to the Real Next webinar series. Today we'll be talking about comparative lease analysis with Dr. Jeffrey Fisher. Dr. Fisher will take us on a tour of multiple scenarios of lease analysis from both a tenant and a landlord's perspective, and how agents can help advise clients in making the best informed decisions on lease renewals or lease restructurings, new locations, or tenants coming into space, and how that impacts values of projects. As always, the audience is muted, but we want to hear your questions if you have them, so chime in along the way in the question box, and we'll try to field them throughout, and certainly open it up for questions towards the end of the hour. So we'll get started now. I think Jeff usually will run for 45 minutes or so, and then open up for questions in the last 10 to 15. So see if you have any, we'll take them. And in the meantime, well, I think we have a few people still trying to get into the room. Jeff, I'll let you start the presentation. And I think, yeah, it's some interesting timing. We should always give it a 5-minute warning because everyone's coming in right at the top of the session here. So let's get going. I think we're loaded, okay. And let the people come in and get settled as you get started.
Okay, and you can see my screen, I assume.
You're looking good. Yep, sound good.
Okay, yeah. And today we're going to talk about comparative lease analysis with RealNext. Again, I'm Jeff Fisher, Professor Emeritus at Indiana University, but have been involved with RealNext ever since the inception, and did at least some of the work on the lease analysis, mainly adding some accounting stuff, which I'll get to later on. All right, so I'm going to talk about the lease analysis with Market Edge, but as I'd like to do in these webinars, I'm going to talk about the concepts, the kind of things that are important in doing a lease analysis, no matter what program you're using, whether you use the Market Edge lease comparison and analysis, which we hope you do, but you could also be doing this in a spreadsheet or some other program, and really the way you go about the analysis would be the same. Should be the same no matter how you're going about doing it. So we're going to do the lease comparison and analysis portion of the RealNext Market Edge, as I show here circled on the left. You would select that from the different options. The Market Edge suite, of course, has all kinds of other stuff you can do, including the CRM and an investment analysis, which was a webinar we did a couple of weeks ago, and the tour book and listings, et cetera. Those are all covered in other webinars. So as Jeff indicated, there's really two types of lease analysis. We were talking before we started the webinar, and we were thinking a lot of people may think of this as just tenant rep analysis, but really the program is designed so you could either look at it from the owner's point of view and looking at different lease alternatives, or from the tenant's perspective, whether it's different lease alternatives in the same space or looking across different spaces in different buildings. You can do this for office, for retail, or for industrial properties. You wouldn't normally do it for an apartment, since not really any long-term leases there typically. It's kind of shown on the right-hand side there. When you're doing a new analysis, you choose whether you're doing the tenant rep or the owner rep, and some other information you could put in, like the start. Well, you'd have to put in the start date of the lease. Some of these things you can change later on, like the lease term or the discount rate on the lease. I'll talk more about why that would be important later on, and how you do that discounting, whether it's the end of every month or the end of every year, and whether you're analyzing things on a calendar year or a rolling 12-month basis. So for an owner rep analysis, now we're looking at it from the point of view of the lessor, the owner of the property that's going to collect the rent. So what we're going to look at there, we'll see a couple examples here in a minute, but what kind of base rent would you collect? In addition to base rent, there's oftentimes some expense recoveries. And we're not now talking about the expenses that you actually have to pay, but the way you can collect additional rent from the tenant based on expenses having gone up above a certain amount. or it's a net lease and you're collecting all the expenses, or however it's defined in the lease. But that would be additional rental income, your expense recoveries. We'll see some examples of that. There may also be some tenant improvement allowance. So you're usually up front, you're giving the tenant some money that kind of offsets, what you're going to collect in future rent payments. There may also be some moving allowances that you're giving to the lessee. May even be some lease buyouts that you're receiving from the lessee. It's also been asked, I showed in red here at the bottom, whether we should then subtract what the owner actually has to pay in expenses. In other words, what I've covered so far in the blue part at the top is the rental income that you're going to collect, including the expense reimbursements, and money that you might have to give the tenant for tenant improvements, etc. But we could also compare across the different leases by then subtracting the expenses that the owner ultimately has to pay, which is probably going to be the same no matter what the lease is. So I'm not sure it really makes a difference in the analysis, but you'll see some people when they do a comparison from the owner's perspective, they like to look at it more in terms of the net operating income that's collected after the expenses. So actually on our roadmap, we're considering adding that as an option, that you could subtract a prorated portion of the actual expenses that the owner has to pay on that space. For a tenant rep analysis, now the question is what the tenant has to pay. So they're going to pay the base rent. They're going to pay those expense recoveries. They may also have some additional expenses that they have to pay directly, which they'd want to take into consideration because that could differ for different spaces. And in one of the examples that I'll show you, the idea is that you're trying to decide whether to renew a lease in the existing space or move. And so if you move, there's going to be some moving costs that you wouldn't have if you stayed in the existing space. So we want to take that into consideration. And you may also get a moving allowance from the lessor that would offset that. And now your TIs, again, what TIs does the tenant actually have to pay? But then is there a TI allowance where you're getting some of that money from the lessor, or maybe all from the lessor? Or, I suppose it may be that you're not even paying any TIs, but you're still getting a TI allowance from the lessor. All depends on what's been negotiated. So the tenant rep analysis is to some extent a flip side of the owner rep analysis, but it's not exactly a flip side because there may be some expenses that either party has to incur that they're not getting reimbursed from the other person. So they are separate analyses, and you'll get a little different answers in terms of some of the calculations. And then again, who pays the expenses? Is it a gross lease, owner pays, net lease, the tenant pays, a base stop where the tenant's paying above a certain amount, and lots of other possibilities I've tried to cover here, sort of the main alternatives you would run into, but the program will allow you on each lease to specify that the way the expenses work, and what the amount of the stop might be, and when it starts and so forth. And at the bottom right there, you see what the input box would look like for something we're just generically calling operating expenses. You can actually have a lot of different expense categories and names for each. In this case, I'm just saying generically, we have operating expenses all together that amount to $5 per square foot per year. The drop downs, you see a little arrow, kind of indicate there may be other choices like per month or just a fixed dollar amount. So there's other ways you could input that data. And like with free rent, there may be a period where you don't have to do the recoveries. And then, as I talked about above, you can see the choices: triple net lease, base stop per square foot, even a cap amount where expenses above a certain amount then have to be paid by the owner. You can only pass through a certain amount, or it could be a gross lease, which would be none. So you don't have any recoveries. once you've input things, and again, we'll see some examples here in a minute, you're going to look at some key measures, like what's the total rent over the lease term. You don't want to just look at that because different leases can have different steps and different ways the pass-throughs work. And so the timing of the cash flows, the lease payments, can be very different from one lease to another. So good to look at the total rent, which you could also look at on a, excuse me, rent per year or rent per month basis, or even on a per square foot basis. But what you also want to do is look at things on a present value basis, where you would put in some discount rate. I'll talk more about that later, but you put in a discount rate to take into consideration that, you know, rent payments received in the future or paid in the future don't have the same impact on you as lease payments that are paid right away or received right away. So you would also want to look at the present value of all the net rent payments, including all those things we talked about, the recovers, the TIs, et cetera. And what a lot of people like to do and build into the program is to calculate something called the net effective rent, which I've highlighted in red here, I guess because that's kind of what I think is the bottom line in comparing different leases, because what it does is it takes whatever the lease payments are, and including the impact of TIs, free rent, recoveries, all that stuff, and says, what would be level lease payments? In other words, the same amount every year, rather than having all the steps and, you know, rather than having TIs just up front. If we convert that to just level payments over the lease term, what would that look like? Because now we can compare all different leases on an apples to apples basis, because we've converted everything to just nice level payments. And that's called the net effective rent. And I'll see sometimes people do that by just adding up everything and dividing by the lease term, which would be equivalent, as I say in the note at the bottom, that would be equivalent to calculating the net effective rent as if you had a zero discount rate. In other words, you don't really care when the money was received. So you could do it that way if you just want to think of it simply as averaging everything. But I think it's probably more appropriate to do on a net effective rent basis where you do some discounting and then spread that out. It's kind of like spreading it out as loan payments, because that takes into consideration that it really does matter, you know, when you receive the money or when you have to pay the money. And Jeff said we'll hold questions till the end, but if you have a question, just put it in the chat box. We're happy to answer things as we go along. We have a relatively small turnout, so if I can't answer your question, Jeff probably can. So don't hesitate to put something in the chat box, and Jeff will keep an eye on the chat box. So let's go through a little owner rep example. I've tried to keep the examples relatively simple so we can focus in on kind of how you would do these different types of analyses. So we've got a base rent. This is an owner rep example. So we have a base rent, $20 per square foot. It's going to be increasing 2% per year. Okay, but again, we could have steps. We could have it be level for a couple of years, jump up, then be level again. We don't have currently in the program the ability to have a CPI adjustment. And every time I ask people if they're seeing CPI adjustments in leases, everybody says they haven't yet. Maybe throw in the chat box if you know if you're starting to see CPI adjustments in the lease. I'm a little surprised that they haven't shown up yet. The idea being that if the CPI goes up by 4%, then you can increase your base rent by some percentage of that. Usually it's like 50% that I've seen in the past of whatever the increase in the CPI was, because that's really the best way to capture the uncertainty associated with what inflation will be. Of course, if you have some expectation of what inflation will be up front when you're doing the analysis, you could still handle that by putting in your assumptions as to how you think that base rent is going to increase, and you can have that rent increasing at different amounts every year. So you can really accomplish the same thing still with the program. In this example, we've got a rentable square feet of 100,000, and the usable is also 100,000. But I'm sure, as most of you know, that there can be a difference between the rentable and the usable, where your rentable that you pay rent on is more than what you can actually use, because some portion of the common areas, the hallways and lobbies and so forth, are prorated into the space that's counted as your rentable area that you pay rent on. So you can look at it in the program based on some of these ratios, either rent per usable square feet that you have, or the rent that you pay per the rentable square feet. Got a lease start date, you got the term of the lease, your operating expenses that are going to be $5 per square foot is increasing 2% per year, which is going to impact your recoveries. And then we could have some free rent. We don't. We could have some tenant improvements. I'm going to add that later, but start off with, we don't. And then the recoveries are based on, I put in 500,000 because that's really what you get based on the $5 per square foot the first year of expenses times the 100,000 square feet that we have for this tenant. So that works out to be 500,000. I could have put that in on a per square foot basis, but I just put it in as the total amount in this case. And again, that's what I typically see, is the idea being the owner says, okay, I'll pay the expenses based on what they are the first year, but if those expenses go up based from what they are the first year, then I'm going to pass that through to you, the tenant, as additional rent. Of course, that's all negotiable. So this shows what the base rent input would look like. You see the amount, $20 per square foot per year, didn't have any free month period. On the far left there, you see I've selected base rent, but we could also have selected operating expenses and taxes, electric, janitorial, and the improvements will be your TIs, and you could have furniture expenses and voice and data expenses and association fees, and and you can rename any of these that you want. So I could have clicked on, if I was live in the program, clicked on that name, base rent, and changed it to something else, although I don't know why you change that, but you could change any of those operating expense names to whatever would be appropriate and that you want to use. On the right there, you see the escalations. They don't have to be the same amount every year. I just did 2% per year to keep it simple, but I could have had it zero increase the first 2 years and then maybe jump up by 5% in this case 2023, and then level off again. You could even have it drop, I guess, in the future. Haven't tried that. Rents never go down, right? Jeff, they only go up. Except
Haven't
during
seen them
COVID.
go down. That's
Yeah.
been a long time.
Except during COVID. Well, we saw some renegotiations during COVID. I remember working with a friend that was trying to use our program. I helped him to look at some renegotiations of leases where they were going to not collect the rent for a while, but then build it into future rent payments and try to figure out a structure that sort of worked for everybody. But hopefully that won't happen again. So that was our base rent input. Then we have our operating expenses. You can see in this case, again, the $5 per square foot. And you see we selected it's going to be a base stop, which means that we pass through anything above that base amount. And there's your $500,000 again. And the expenses are going to also increase by 2% per year. I guess what I'm assuming here is the Fed target for inflation. hopefully we get to that without too much pain. Obviously, we've been running at a lot higher rates of inflation over the last couple of months or more. Let's see, anything else here? I think I've covered this.
Yeah, some of the audience members, Jeff, were commenting that they have started to see some CPI adjustments getting into leases, and some actually over a year ago, and they've gotten the benefit of it with, or depending on which side of the negotiation they were on. The one side got the benefit of an 8.2% increase, and one got the pain of that. So
yeah, they were ahead of the game. I remember
yeah,
during the investment analysis webinar, it must have been a year ago, that we did one that I said, you know, I'm not sure why
Should
we're not
start looking
starting
at
to
it.
see CPI
Yeah,
adjustments in
I know you
leases
did.
again. So maybe it was somebody during that webinar that actually followed my advice. That'd be interesting. So here's our operating expense input. I think I've covered this pretty well. And again, I just generically called it operating expenses, but I could have put in taxes and insurance and maintenance and, marketing and whatever I want, if I want to break it out. And I might need to do that because maybe the rate of increase is going to be different on each. Might be going up faster for insurance, and you know, the property taxes, might be level for a couple of years and then step up. So typically you'd probably have different expense categories, but that's just additional work, right? Same concepts, same way you'd put in the data. So this shows the rent calculation. So base rent, operating expenses. But again, as I note there, this is not the operating expenses that you're paying. This is the recovery. This is the additional rent that you're collecting. So why is it zero? Well, first of all, in 10/2020, that's when you first signed the lease. There's nothing that we're going to see when we have TIs, or if we had some moving allowances or something like that, that would pop in there when you first signed the lease. But you notice there's also a zero in that first year, the 10/2020 to 9/2021. Well, that's because again, the way this particular lease was structured, we're only passing through the expenses above the first year amount. Okay, so it's going up in year two, so we're passing through that additional 10,000, then we're passing through the 20,200, etc. So that's being added up to get our net rent. So it starts off at 2,000, then goes to 2,050, etc. And again, as we'll see later on, maybe what we'd like to also see is what if we took that net rent and said, what would it be if it was just level payments every year? And that's going to be our effective rent, net effective rent. We could add some tenant improvements. So in this case, we're saying that the tenant's going to have to pay 20, but we're allowing 10. So actually for the owner rep analysis, the 20 isn't really used. It'll be important from the tenant's perspective because they have to pay it. But the owner is saying, I'm just going to allow you $10 per square foot. And so we'll see that that's going to show up. See it right here in that $1 million, the $10 per square foot times 100,000 square feet. So we've got a negative, right? Because it's money that we have to give out to the tenant. And again, that would be reflected in our net effective rent calculation. It'll take that along with the rental income that we're going to receive and treat it as if you just received positive numbers every year that were level. So this shows you what you would see then in the RealNext lease comparison analysis. At the top left there, you've got your total. That's have to take a minute to kind of digest because there's two columns and it says total / PV. That means on the first column, the one that says occupancy costs, we're not considering any discounting. So it's just adding up everything. So the total rent, whereas to the right, it's the present value of all the rent over the whole time period. And both of these take into consideration your tenant improvements. So then you have, that's why we call it occupancy cost. And then on an annualized basis, you see the average just without any discounting, and then the effective rent, and then put on a per square foot basis. And sometimes, of course, we like to also look at it on a monthly basis, as well as looking at it per usable square feet. Actually, in the program, you can choose whether you want to look at it usable versus rentable, but we're of course calculating the rent based on rentable square feet if it was different from usable. But I think Jeff, it probably makes the most sense to compare things on a per usable square feet because that's what you can actually use. And if you're looking at different spaces, you may be paying more rent because of the way they calculated the rentable area, but what you care about is the rent you're paying for the amount of space you can actually use. I remember
I think
one
that
of our
makes the most sense.
colleagues, one of our colleagues at RealNex asked me, which should you use per usable square foot per rentable? Hopefully I gave him the right answer. The top right there is something I'm going to talk more about later on. Probably something a lot of you have never even seen before, where it says right of use asset and lease liability. This has to do with the fact that under new accounting rules, Financial Accounting Standards Board rules that kicked in for all corporations this year, you have to also show leases on the balance sheet. The idea being that, and again, I'm going to come back to this in more detail later, but since I started, the idea is that what a lot of tenants, lessees, I should say, used to do in the past is use leasing as a way to get their real estate off the balance sheet. If you owned the real estate and you borrowed money, you'd be making mortgage payments, but if you lease it, they wouldn't have to show any impact on the balance sheet. So the Financial Accounting Standards Board said, well, you really have an obligation that's a long-term obligation because you're leasing the space. So what you've got to do is show a liability on the balance sheet that shows that you've got to make these lease payments, just like you would if you had mortgage payments. But you also have a corresponding asset, which is your right to use that space. So it's called a right of use asset, which is just your right to use the space over the term of the lease. So you'll probably hear more and more about that if you haven't already. And we built that into the program because that's, especially for tenants, become an important consideration. And I'll show you that in some examples why that might matter. Bottom, we have just some charts, the net occupancy cost, and then the balance sheet impact of this right of use asset and lease liability, which are both amortized over the lease term. So you see they eventually get down to zero. They don't start off with the same amount in all cases because of the way the tenant improvements impact the lease liability, but not the right of use asset. Accountants do strange things. What can I say? So the idea again is that this impacts lessees mainly, and some new accounting regulations. Lessees have to show the lease is both an asset and a liability. You've got this right of use asset and you've got this lease liability, and they're amortized. All right, I'm going to come back to that. And Jeff, we had in the brochure that we were going to talk a little bit about the discount rate. So I actually pulled this in from what FASB says is a way you come up with the right discount rate to calculate these liabilities. I guess I didn't say this before, but to come up with that lease liability, it's a present value of what you're going to have to pay over the entire lease term. It's kind of like when you borrow money on a loan, the mortgage amount, the amount you're borrowing is actually the present value of all the future mortgage payments. So the idea here is, well, this lease liability is the present value of all the lease payments that you're going to have to make. And it says you could use the lessor's implicit interest rate, but how the heck do you know what the lessor, how the person that's leasing you the space took into consideration what that space was worth, and what that implied for the interest rate that you're paying on the lease. So probably what makes the most sense, so I highlighted it here in the yellow, is the lessee's borrowing rate. It says incremental because it'd be like on new money that you borrow. So that probably makes the most sense. If you're discounting anything that has to do with a lease, what would it cost if the lessee had to go out and borrow money, and what would they pay? And so let's use that when we do these, not only the lease liability calculations, but also the effective rent calculations. All right, how do we get this net effective rent? I've kind of already talked about it, but the idea is to take the present value of the actual rent minus any tenant improvements, and then find the level rent that has the same present value. So that's what we mean by the annual net effective rent. We could add moving allowances and commissions. So you just kind of see what it would look like if we brought that into the example that we just talked about. Okay, so you got the minus million for the improvements, the minus 5,000 for the moving allowance, 520, 404 for the commissions. Okay, let's go to a tenant rep. I've got two tenant rep examples. The first one, the way I thought of this is it's the same space, but there's different ways we could structure the lease. At the bottom there, you see three lease alternatives. It could be a net lease at 17 per square foot with no rent escalations, or it could be $25 as a gross lease. But now, of course, the owner is going to have to pay the expenses, and the lease is going to increase by 4% per year. Or it could be a base stop, where again the owner pays the first year expenses, but then anything above that's going to be passed through. And then you have the other terms up top, which I kept the same for all three alternatives. Of course, some of these things could also vary with each alternative, like the amount of tenant improvements. You could negotiate different tenant improvements for each and so forth. But one of the things I was trying to do in this example is not only see how the net effective rent ended up being for each of these different alternatives, which certainly look quite different, right? 17 versus 25 versus 24, but also the impact on the tenant's balance sheet for each of these, because they each impact the balance sheet differently. So I don't know about you or Jeff, but I can't just look at all three of these and say which one's better. You want to pick one, Jeff? You think it might be better? Should we pay $25 per square foot, but have to pay the expenses, or only $17 per square foot, but
Don't
the
think I
tenant
could
has to
do
pay
it
the
without
expenses? Yeah,
proper analysis. So this
you're
is
you're
what it's
better
all
than me.
about.
Yeah, better than me if you can just look at this and figure it out. And this was a simple example, right? We got to have different TIs for each, and some moving allowances thrown in, some free rent thrown in. So I just don't know how you would do it without running it through either a spreadsheet, which every spreadsheet is going to be different, right? Because all the leases can be different. So better to use something like RealNex. So I just showed the base stop lease. We've already kind of gone through how you'd put in the data. So maybe focus more on the answer, but I do show here the input for the operating expenses at the top, and then at the bottom your input for the improvements. To again emphasize that the tenant in this case will pay the difference between the 750 and the 500, and then what your output looks like we talked about before. So the total rent doesn't look too different. You see on the far right there, the graph, the total rent, after we take all the expenses and reimbursements and all that into consideration, doesn't look too much different. We go to the next slide, which I think is probably the most interesting. You see a comparison. This is something you can do in the program where you get a comparison across all your different leases. So you see the net lease, the gross lease, and then the base stop. So your effective rent is just slightly lower on the gross lease. And you'd kind of expect if it was a relatively sharp lessor that and lessee, right, you'd have gotten to the point where the net effective rent should be pretty similar across all these. But you see it is a little bit lower in this case with the gross lease. So you might think that's the best alternative. But we're looking at it from the tenant's point of view here, and notice that at the bottom, and I know this is probably relatively new to most of you. It was new to me when a couple of years ago I realized we needed to add this to the program, and I had to learn some accounting stuff pretty quickly, try to figure all this out. You'll notice that with the gross lease, even though that has a lower effective rent, I've got to put a little over $12 million on my balance sheet as an asset, and also close to $12 million as a lease liability. Why do I care? Well, that affects the income that I'm reporting, because I've got to amortize this. That's going to affect the expenses that I report. It could impact my ability to borrow additional money because I've got this liability on the balance sheet now. Whereas with the net lease, you'll notice that there's still a liability and a right of use asset, but it's a lot less, quite a bit less, over $2 million less. And that has to do with the fact that with the gross lease, we've got the liability has to do with the present value of the lease payments, and with the gross lease, the payments are higher. The owner's going to be paying the expenses, but it turns out if you don't know what the expenses are going to be, they don't have to be part of this calculation of the asset and the liability, because you don't know what it's going to be. It's uncertain, so that they're not included in that calculation. So it really does make a difference. Some tenants may not care. They're not reporting to shareholders or other investors, and the balance sheet isn't relevant for them. But there are tenants that this really matters. I know we've talked to some users of RealNext, and it's like, boy, we're sure glad you added that in there, because this is something that we've got to deal with. And you may be hearing more and more about it from tenants. At least you have the option that you can look at it. You can create nice reports. That could probably be a webinar on its own, all the different reports you can create. So I'm just pointing out here that once you've done all this analysis, you can create a nice report, which you can then, preview as a PDF file. You can email it to your client. You can e-publish it on a website, and you can select what all you want to have included in the report, and you'll get this nice comparison across all the different leases that you've analyzed. Nice pictures at the top, and you can customize these reports in a lot of different ways. It's all kind of the same information that we've been talking about, as well as some other information you may have wanted to supply on each of the alternatives. So nice. I think we've spent almost as much time on creating nice reports in the program and being able to customize it and stuff as we spend on the actual calculations, which I think differentiates from, especially if you're just using a spreadsheet or something, you wouldn't be able to create nice reports like you can. So I added one more example here that I used once before. I won't go through all the details, but more focus on why you'd want to do this. So the idea here is you have a client whose lease is expiring. This was sort of based on a true story of a situation we were analyzing. You've got a client whose lease is expiring. They're trying to decide whether to renew the lease in the same space or lease space in a different building. So what are the things that they'd want to take into consideration? They may have some moving costs if they move to a different building. So you'd have that and the alternatives that involve different buildings that you wouldn't have if you stayed. They may incur some costs for tenant improvements if they move. On the other hand, if they renew the existing lease, maybe the space is okay. Not that you couldn't negotiate for some tenant improvements, but maybe the space is already fixed out and you wouldn't need to do anything. Of course, you may also get a break on the rent if you stay versus moving somewhere else. Although it depends on the market. New tenants or new owners, I should say, trying to lure you in, may offer you a better deal, especially in a weak market, where there's oftentimes an opportunity for you to move from a B space to an A space. New building may have lower class or worse location, so you need to take that in consideration. Or it could be the other way around, right? Maybe I should have said that. So it's really hard to compare leases with all these different things going on. Key inputs are going to be the same as we already talked about. I just repeated some slides. Originally, this was a standalone example, so kind of covered the same points here, that you need to have all these different inputs that we talked about, and these are the kind of things you'd want to look at, including the net effective rent, and then the financial statement considerations that I already talked about. So Again, you're doing a lease comparison analysis. This was a office tenant rep example. You got your nice output in the program, but let's focus on the comparison, especially in a summary that I put together on the next slide. But before I get to that, you can see each of the alternatives. There was staying in the existing building, which is the first on the left. And then you had 4 different alternatives in this case. So got your total rent for each alternative, the average annual rent, all the different kinds of metrics we talked about, including your present value for each alternative, your net effective rent for each alternative. You see the Concord building, in this case, the third one over, has the lowest effective rent, but you got different impacts on the balance sheet for each. I didn't mention this before, but there was also differences in the class of each of these buildings. So what I did here is using one of the charts in the program, added some comments designed to be just, here are the kinds of things that you might want to think about. You can do all these calculations, and that's certainly important, but there's also some art as well as science involved in this. Because you got some trade-offs here. Like I say, the first one, you can stay in the current building. There's no moving costs or TIs needed. Although the rent is a little high. It's a Class A building at an A location. That was part of the things you could input into the program and have as part of these reports. And it has the least amount of liability on the balance sheet. Okay. This second one there had a lower rent, even after considering the TIs and moving costs. Also a Class A building, and it was an A+ location. But it has more of a lease liability on the balance sheet. So if you're concerned about the lease liability, yeah, you may want to think twice about that one compared to some of the other alternatives. Third one had the lowest effective rent, but it was a Class B building, and it was at a B+ location. So if that's really important to you, then just because it has the lowest rent doesn't mean it's the best. Maybe you're better off paying more rent and going for the Class A. Just really depends on the tenant, right? And then next one was a Class B building, but it was an A- location, but it was a little bit more net effective rent. And then the last one was a Class B building, B+ location, didn't have the lowest rent, so probably throw that one out. So probably boils down to a choice between just 2 of these, and the trade-off between what results in the lowest effective rent over the lease term, considering the moving costs and TIs and everything, but also, do you care about the impact on the balance sheet or not? So
Jeff, you didn't do it that way here, but I think it's helpful to explain that in the transaction manager application, there is a more of a qualitative comparative matrix that you can put together. So in Market Edge, we have the financial analysis that you've gone through thoroughly, but these comments that you've put into the financial analysis could also be shown on a grid and like a property tour survey that you'd be able to analyze each property with the financial analysis to back it up, but also based on these more subjective types of evaluation criteria that you're looking at as far as quality of space and location, amenities, proximity, other attributes that might be key to the decision-making process.
yeah, good point. Again, art as well as science, right? There's always judgment involved in the final decision. So we can't quantify everything, but certainly without the numbers, I don't know how you'd make a decision either. So kind of some summary comments. I think it's hard to compare leases without considering all the factors that could impact the rents. The effective rent, I think, is one of the best ways to compare leases, since it considers everything, the timing of the cash flows as well as all the amounts, and show me the money, Jerry Maguire. Tenants might also be concerned about how the lease impacts their balance sheet, asset and liability. And so the RealNext lease comparison and analysis is a useful tool to help them in all this analysis. But of course, as Jeff and I have both been saying, there's judgment involved, and these subjective comments you also want to take into consideration. All right, boy,
It's
145,
interesting.
right,
You think
right
about,
on the dot.
yeah, perfect. So yeah, well, we'll see if there's some questions that anyone in the audience has. You showed the chart so clearly that the asset and the liability differential was just the TI. So, and that's typically a small percentage. So it's almost a wash between the asset and the liability, but
Right,
it
right,
does make a difference, as you pointed out, because sometimes you don't look at the net and sort of the impact on equity. But if analysts are looking at the company with return on asset, or someone's being evaluated based on their total liabilities and what their liability threshold is, and if they can't borrow more, it limits impacts borrowing capacity. A number of reasons why the actual individual numbers would have more of a meaning than the offset between the two, which is de minimis.
right. Yeah, certainly any corporation that's leasing a lot of space in a building, I think this would be a key consideration for them. Because, like you said, they want to know what their return on assets are. And so if you got to put that uh, lease on the balance sheet, your return on assets is going to be lower. And of course, that's what the FASB was trying to do, is say, look, you guys are playing games here by creating
Yep,
leases.
called a soft balance sheet.
You really own the building, but you're pretending like it's a lease, right? So they can't do that anymore. Damn accountants.
Well, what it used to be the difference between the operating lease and the capital lease, and that people would
Exactly. Right.
structure leases differently, take on terms that were different based on
Right.
that.
Right. No more. They said got to do this for operating. I'm glad you
Yep.
mentioned that. 'Cause you got to do this on operating leases as well as financial leases. There's certain
So a
criteria
question
that.
that go ahead, keep going.
No, no. I think that covers it. We don't want to make this an accounting
Yep.
webinar.
So the discount rate, a question is that it's a different rate likely based on the tenant or the landlord and what they would use as a discount rate because of their particular situation. So the question is, do you ask the tenant what they think it should be? And the answer is, if you're evaluating it on behalf of a tenant, yes. I mean, they're going to
Yeah.
have their perceived
Yeah.
capital costs and other
Right.
circumstance
Right.
that for
Because
each
they're the
tenant,
one.
that number would be different. Yeah.
Yeah, because they're the one that's going to be making these payments. So if you're trying to help the tenant, you want to look at it from their perspective as much as possible and what their opportunity cost is on the money. Um, so I think, and it would be different from a rate that you would use in an investment analysis, because the risk of an equity investment in the whole property can be quite different than the risk associated with, um, you know, uh, if you're just looking at a lease by itself. A lease is probably less risky than um, the risk associated with the entire investment in the building. In fact, sometimes get off on a tangent, but when we do investment analysis, sometimes people even discount the lease payments at a lower rate than they discount the rent that you get from lease renewals and from selling the property, because they're different risks.
Yeah. So the same lease with tenant A and the same lease with tenant B could clearly and would more than likely have a different discount rate. So it has less to do with the lease and the building and the quality of the building. None of that matters. It's really the cost of capital and the opportunity that particular tenant would have and what they'd be looking at.
Right. Good point.
One of the other things that, just for the audience, it's a little bit of an aside, but it has to do with this type of credit risk management. That RealNext has just formed a strategic partnership with a company called Otso, and oftentimes landlords and tenants get into a negotiation at the end of this analysis that says there's another number here, Jeff, that we didn't put in it and we should think about. It's what is the security deposit? What is the letter of credit? What is the other way to enhance the lease and mitigate the landlord's upfront costs that they have for the TI, the commission, and some of the other costs that they have going into the lease, because that is, as you pointed out, is amortized over the life of the lease. But if in the first month the tenant defaults, the landlord is at an exposure for all of that cost that they put up front. And it's difficult for particularly small regional tenants or non-credit rated companies to have to come out of pocket and put up 250,000 or some significant amount of cash, or to have a letter of credit for that similar amount. So what RealNext has done with OTSO is we've structured a relationship to enable your clients, the either tenant or the landlord, to take advantage of the tenant lease insurance program, where they could pay as additional rent an insurance payment, so they'd have A-rated credit coming into the to back the lease up, and they wouldn't have to put that capital on the sideline and have that additional capital not put to work. So instead of putting $250,000 in a bank somewhere, sitting in an account earning no interest and doing no good except protecting the landlord in case of default, they could pay a couple of dollars more per month in rent and have even more coverage. So likely up to $1 million worth of coverage instead of the $250,000 in security. So for the landlord, they're getting triple or quadruple the amount of credit, insurance, and enhancement. And from the tenant's perspective, they're able to keep their cash and put it to work in other useful ways rather than putting it aside and holding it in case of a default. So if anyone has any questions about that or interest in that, let me know. Just send me a note at jfin@realnext.com, and we can help you out and see if you have any circumstance that might be able to benefit from that new insurance program that we've worked to make available. And yeah, and as an agent, you can get some of the you get a referral fee opportunity for creating the opportunity for the insurance.
Gonna have to work that in my textbook. Lease insurance as a new topic.
Yep. And I think the other part is to model in the security, because for most non-credit tenants, they're going to have to put some money aside, and that's a lost piece of the equation here that we didn't factor into this, at least this example. But I think that's it for today. We've got the questions covered. Jeff, you covered the bases well. You've as always, done a great job to educate the audience. We appreciate that and appreciate everyone showing up and participating in the program. And we look forward to having you in future sessions.
Thanks, everyone. Thanks, Jeff.
Thanks, Jeff. Have a great day. Bye-bye.
Have a good weekend.